I'm Jordan Lulich. This is the Lulich Corner, and today I get to sit down with Jake McCrae from CrossCountry Mortgage. So first off, Jake, thanks for coming in, sitting down with us, and just having a conversation and sharing your wealth about mortgages. I really appreciate it. Before we get dived into our conversation, if you could just talk a little bit about yourself and your background and introduce you to anybody who's listening today.
Well, first, thanks, Jordan, for having us here. We're very excited to get on the podcast. I know you've had my partner, Brian, on here before, so it's great to have both of us on here now. So a little bit about me. I have lived here in Florida for about 7 years, and I've been a mortgage broker here for about 6. I run the cross-country branch. As a branch manager, we just actually moved our office location. We were in Pelican Plaza down off of Beachland, and now we are over by the Navy SEAL Museum, so just across that Indian River PSL borderline.
Okay. Well, congrats on your move and finally getting settled in.
Thank you. March 26th, come out and see us for our grand opening. Plug us out there.
So, I appreciate you coming in. So we've got a lot of people that are, either first-time home buyers or, maybe just looking to buy and finance a real estate purchase here in Florida. And I think talking and sharing your wisdom about transactions that maybe have gone wrong or that almost went wrong, I think that would be a great learning opportunity for those that are interested in maybe making their first home purchase. And so what are some common mistakes that you see that home buyers make, going about the process in terms of applying for a mortgage and trying to obtain financing?
I'd say the biggest thing I notice is most people do not know what's on their credit report. Everybody knows if you have a car payment, you have a car payment, or if you have a couple credit cards, but some people forget that. They might have an installment loan that they've been paying off, or their student loans are in deferment, but those count towards your debt to income ratio. So that's a big piece of the puzzle. A lot of the times where people are like, hey, I got $200,000 in student debt. How does that affect my debt to income ratio? Well, more often than not, if you're not paying on it, you're still having to take into account 1% or 0.5% of what that total value is towards your debt to income ratio.
So how useful are those, some credit cards companies, they've got a credit check, built into their online platform, or there's Credit Karma. And how accurate are those tools to check your credit and to understand what's showing up on your credit report? Is that something that's reliable, or is there a better way to know what to expect and what to anticipate?
It's definitely a good baseline. If you use Credit Karma, CreditWise, Experian is always a great one because I think they offer it for free still. They're great to at least see because, as CrossCountry, we'll always run, if you put in an application with us, we're going to run a soft pull. So it's never going to ding your credit up front until we go into contract. So if you kind of know ahead of time, hey, I have these things, there might be something else showing up, we can find that out after the application process. But at least we know in the fact-finding time frame that we're going to know, hey, we're kind of looking at this. There might be a little bit more, there might be a little bit less.
At the end of the day, does credit really impact your ability to obtain a loan? Is that your credit score is how impactful and how important is your credit score when you're trying to get a mortgage?
I'd say the two factors that are most important when you're, trying to obtain a loan are, one, credit, and then what you're bringing to the table as far as down payment. Those are the two main factors that you're going to deal with. The more money you put down, the less that credit really plays a part. You still obviously have to be above the qualifying credit score, but it's kind of like a catch-22 where you put, the more you put down, the better your rate can be. But the worse your credit score can be, the worse your rate's going to be. But credit definitely is a big factor. I'd say just so most people know, when you're talking about an FHA loan, the bare minimum you can be is at 580.
Is it impossible to get a loan at 580? Or I know that's the bare minimum, or if you have a 580 and above, then you can definitely qualify for some type of mortgage.
You can, as long as you're above a 580. That is, like I said, the bare bottom baseline for FHA. So you can qualify at that point as long as you have 3.5% to get or to put down, and you can cover the closing costs at that point in time. Conventional, you're looking at 620, and then VA doesn't really have a set credit score, but really 580 is kind of the mark. FHA and VA kind of run the same when it comes to that.
In terms of your credit score, if you do have a 580 or 600, or just say in general, if you have a lower credit score, then is it possible to increase your credit score, or is that going to be a journey that takes years on end in order to do.
Well, I'll say, yes, it is impossible to improve. And there's ways that we help our clients basically by using what's called a wayfinder. Most mortgage companies have this tool, and it allows them to see like, hey, if I put down this much on my credit card and get my usage down to this, my estimated credit score is going to be in this range. Kind of going back to your question on, what do most, first-time home buyers not know about the mortgage process is go to a loan officer and have a consultation. Just because you speak to somebody doesn't mean that you have to apply for a loan right then and there. It's better to know kind of how the process works, but better yet, put a plan together. So if you do have a lower credit score that's below 580, or, you really want to put 20% down on a house because you want that equity value, and you want the no private mortgage insurance, you got to have a 620 for conventional. But just to have a consult and at least know how the process works and being able to put a plan together is crucial.
Yeah. And are typically, with you or with other lenders, is it free to have those types of conversations, or does that conversation cost money for people who maybe they've never got a mortgage before?
I haven't seen anybody charge, so yeah, they're usually free consultations.
So I know you mentioned credit report, having a free consultation. Is there any other advice that you can give somebody who's interested in buying their first home about the process and trying to obtain a loan?
I would say if you really want to, if you're a first-time home buyer and you want to get into your first house, best thing you can do is start saving money and start to get around $20,000 to $25,000. That's a good starting point to buy your first house. Typically, when you're looking at like a $300,000 home, typical closing costs, if you're going FHA and you're putting 3.5% down, you're looking at between like $20,000 and $22,000 in closing costs with down payment and the closing costs added in. Okay. So total cash to close. But going back to the credit report again, like if you know what's on your credit and you know what you need to tackle, another quick tip too, if you get your credit usage under 30%, that's when you really start to see your scores go up. If you have all of your credit cards under 30%, at least monthly, now you can, use them through the month, but as long as you're paying them down to under 30%, your score's going to go up.
For maybe people who have started in the mortgage process, whether they're under contract or maybe pre-approved, what are some things not to do if you're a home buyer? Like what do you not want to do to make sure that you're not jeopardizing your entire home purchase?
First, don't open up any other installment loans. So if you're trying to do, let's say, a debt consolidation, or hey, I just need 10 grand to fix something, or I need to pay off a credit card, don't open up an installment loan. Any type of loan or any other type of trade line you open could jeopardize you qualifying at that point, especially if you're at the top end of the debt to income threshold. Other thing I'll say, which kind of piggybacks off of that, is, if you're in the loan process, you're under contract, and maybe you sold a car and, you don't have a car right now, just rent a car.
Rent a car.
Rent a car for now, because I've seen people who they're in the loan process or they're in the pre-approval stage, and they go and buy a car, and their monthly payment goes from something that was $0 to $1,000, and that might completely blow you out of the water for qualifying. Before you make a purchase, I guess I'll say this too: talk to your loan officer and let them run the numbers and see what basically you can afford compared to what you're qualifying for.
And the reason behind that, right, is because you might have a debt to income ratio where you might be within pennies or dollars or hundreds of dollars, where if you go and make a purchase, or if you do that debt consolidation, or if you purchase an ATV or jet ski or boat or car, and you're incurring an additional monthly payment, then you're ultimately might jeopardize your debt to income ratio. And if you have a high enough debt to income ratio, then you can't qualify for a loan anymore.
Correct.
So what are the differences? Because I know you've thrown around FHA loan. You were talking a little bit about that before. What are the differences between the three main type of loans, VA, FHA, and then conventional loans?
So FHA is typically what most people think is your first-time homebuyer loan. Your minimum bring down for down payment is 3.5%. It's the lowest credit rating that you can qualify for, which is going to be 580. The biggest drawback is it comes with PMI or mortgage insurance. And basically that allows the government to make sure that, hey, this is insured and that, you're not going to default on your loan. Conventional, I'd say, is by far nationally the most popular product. Most people think that you have to bring 20% down to use a conventional loan. You do not. You can go as low as 5%, and then they do have first-time homebuyer programs that start at 3% down as well. One is home ready, the other one's home possible. So you do not have to bring 20% down for a conventional loan.
Interesting.
Faux pas.
Okay.
Fake news.
So once a buyer decides, all right, I want to go get a conventional loan or an FHA loan or a VA loan, how do they secure the best interest rate possible in trying to secure that loan?
So when you're first putting through your application, there's going to be a rate for that day. What we've become really good on is kind of watching how basically the bond market and which the 10-year and the 30-year treasury, what kind of control mortgage rates. Another kind of like sidetrack comment is like if you think about rate cuts, and that's kind of what everybody hopes for, is all these federal rate cuts, those don't directly impact mortgage rates.
Mm-hmm.
The 10-year and the 30-year are always going to be the ones that kind of control mortgage rates. Now, if we get a Fed rate cut, great. Usually that does correlate to the rates moving, but it doesn't always happen that way. Going back to your question, the best thing you can do is if you have a great loan officer, they'll be able to say, hey, like we're expecting some movement here. Let's keep your rate at what we call a float. So basically it's sitting at a certain rate. It's not locked in at that point. And then typically before appraisal or right after appraisal is when we're going to lock you in. Now, if we know, there's a trend that it could go down, we're going to lock you in before that time. We use a system called NBS Highway that kind of gives us rate lock alerts so that we know that if the market's about to tank and rates are going to go up during the day, we'll lock you in before that's going to happen.
Nice. And what about costs? Because there's a lot of costs involved. You've got some costs before you actually get to closing. You've got costs at closing. You've got interest rates, right? So what are some hidden costs that you think that home buyers should be aware of? Kind of making sure that they're not paying too much, or that they maybe didn't anticipate a certain cost and they just need to be aware that these costs are expected and should be anticipated.
I'd say there's really 3 during the loan process that most people either don't know or they kind of forget about when they buy a home. One is the inspection cost.
Okay.
Typically you're going to get your home inspection within the first 7 to 10 days of the contract. The other one is the appraisal fee. And then the third one could be your WOD. So if you have to get a
Wood destroying organism.
There you go.
Yeah.
If you have to get that inspection, and then your survey fee typically is paid up front as well.
Yeah.
So those are kind of like the 3 to 4 that are typically paid either before closing, or sometimes I've seen the survey fee
at closing
as well. Yeah. But I'd say those are the ones that most people are like, well, I'm going to pay everything at closing. Well, wait, you got probably about $1,100 to $1,200 between the inspection and the appraisal that you can pay for too, depending on the price of the home.
It's good to just be aware of all the costs involved so people can know what they're getting into. But Jake, I know we're wrapping things up. So if somebody does have a question about mortgages or just what we talked about, what's the best way to reach out to you and learn more about, from you about what we talked about, or if they have maybe a different question that was sparked during the conversation?
So my cell phone number is 818-577-7495. I know it's an LA number, but I promise I'm local. But that's my direct cell if anybody has any questions. And then our email is jacob.mccrae@ccm.com. And, if you're looking for a free consultation, at least to get a plan put together, or if you're somebody that owns a home and wants to review their mortgage and see why their cost is going up, please reach out. We're here to help the community.
Well, thanks for listening in, Jake. Thanks for joining us, and we'll see you next time. I'm Jordan Lulich, and this is the Lulich Corner.